Thank you for joining me for a quick look at some recession indicators you might have missed. Now, economic data has a high degree of correlation to the stock market at times. In the longer run, a growing economy leads to higher earnings for the companies that are publicly traded. Those higher earnings translate generally into higher stock prices. An economic contraction is often associated with bear markets. That's when we see the economy stop growing and earnings tend to fall during periods such as this. Because of this high-level relationship, investors often follow economic data. Now, many limit what they're watching to the unemployment rate and other popular indicators, including the yield curve, which tends to invert before a recession, and we have other videos about yield curves. Although some data is less popular, it can still be very useful. And let's take a look at some of those less popular indicators. Here's a yield curve of the 5-2 Treasury. So what that means, it's the 5-year minus the 2-year. And the more popular one is the 10-2. That's the 10-year minus the 2-year. Well, what we find is the 5-2 leads the 10-2. And the 5-2 has already inverted. That means we should expect the more popular 10-2 to invert soon. So that's what we're watching for now. The 5-2 has already told us an inversion is likely in the more popular yield curve. So we already have a warning, recession on the way. Now, as an economy grows, it generally requires more electricity. And when you think about that, that makes perfect sense. If you're producing more stuff in a factory, for example, you're going to be running more machines, you're going to have lights on longer, you're going to see electricity usage increase. This is a very popular indicator to monitor for countries where we don't get great data. Intelligence agencies, for example, try to monitor the electricity output of North Korea and China to try to determine whether their economies are growing or contracting. Well, it applies in the US as well, and over the past quarter, we have seen industrial production of electric and gas utilities decline year over year. That's unusual because it comes at a time of year when we expect demand for electricity to increase. This decline began in November, and in December, holiday lights go on, and although it might sound like a trivial factor, it increases the seasonal demand. So seasonal demand was not enough to lead to an increase in production. Electricity production is down, and it's likely that's indicative of economic factors going on that we don't see in the data just yet. Now, when companies produce stuff, they tend to ship it to their customers. And there's various ways of measuring demand for shipping. One of the most popular, the Baltic Dry Index. And that's shown as the blue line here. As you can see, the Baltic Dry Index has been in a downtrend since last summer. It basically fell off a cliff beginning at the end of December, and that's the same time the stock market rally took off. The stock market shown as the black line here. So we have a big conflict in the data. Economy slowing, stock market accelerating. Basically, shipping demand collapsing. So this is an important one to watch. Another economic indicator we might not see advertised much is year-over-year growth in Mercedes Benz sales. And this might sound like a trivial concern. I mean, there's maybe 350,000 sold in the past few years. Well, when the average selling price is about $90,000 and there's problems with individuals at that level being able to afford their new cars for leases or whatever, many of these are business-related expenses. And what this means is there's probably a decline in small business revenue. Now we see this particular data series has turned down before the last few recessions, and it just turned down again. So we don't really get false signals. We get early signals at times, but it's pretty reliable. When Mercedes is selling fewer expensive cars, there's a stress in the economy. RV sales, recreational vehicles, might be the ultimate luxury purchase, and they require a great deal of consumer confidence. When you're buying a new RV, you're spending a lot of money, and you're committing to spend a lot of money in the future on maintenance and potentially storage costs. Again, this is an indicator with a high degree of reliability. We tend to see a dip right before a recession. The only time it dipped when we didn't have a recession was the 1994 rolling bear market. And if you weren't trading at that time, you may not recall, that was a brutal market where we had a bear market sector by sector. The overall decline never reached a bear market level, but individual investors and institutions just got pounded sector after sector. And we now have another signal from this indicator. So RV sales down year over year in 2018. It's happened before, and it hasn't been good for the stock market. Now, recessions start when consumers are exuberant. So here's a consumer confidence index. We are at a level associated with previous recessions. We always see a sharp rally right before the recession begins, and then we see an equally sharp decline. Well, we had the sharp rally. We're now waiting to see if that decline follows within a month or within a few months, but it will happen. So what we're seeing right now, obscure data points point to a recession. 5-2 yield curve, electrical production, Baltic Dry Index, high-end Mercedes Benz sales, recreational vehicle sales, consumer confidence. They're all telling us potential problem ahead. And this is the kind of data we need to look at if we really want to get an edge in the stock market. Thanks for joining me for this quick look at obscure economic data.